Good afternoon, everyone. Thank you for joining our senior living, specialty multi-residential, and healthcare panel. Today, we have the privilege to have with us Mr. Nitin Jain, CEO of Sienna Senior Living, Shailen Chande, CFO at Northwest Healthcare, Mr. Scott White, CEO of Invesque, and Mr. Stavro Stathonikos, CEO of NexLiving. Thanks to the four of you for joining us today. And we have quite a lot to cover, so we'll go into it right away. So maybe the first question, I'll go to Nitin. I was wondering if you could give us kind of an overview of how the pandemic, like how the portfolio performed during the pandemic. Where are you today? Now, almost like I want to say post-pandemic. And how did the, I guess on top, how did the split between senior living and LTC worked out for you guys?
Hi, good afternoon, Fred, and thank you, Laurentian Bank and Fred, for having Sienna over. I think that's 4 different questions, so I'll try to ensure I answer them. I don't want to take the entire time answering those 4 questions. I would really start the first one. I mean, this is not a surprise to anyone that the senior living sector was hit hard the most as a country, frankly, even globally. And I think it'll be remiss not to say that the reason we are even talking about the future is because our 12,000 team members, like many thousands of healthcare workers, continue to show up to work. When people were worried about whether they had enough toilet paper or not, our team members showed up for work before vaccines. And I remember one of our sites where I visited in downtown Toronto. We had 100 plus cases in that home. And the first employee I saw was a PSW who just came back after contracting COVID. This was before vaccine. And I thought she was going to talk about how she didn't have the right personal protective equipment. And all she talked about is how she's so happy that she's back because her residents need her. And that was December 2020. And in that instant, we knew we would be okay because we have an incredible team who are so aligned to our purpose. Really post-pandemic, one of the things we've all seemed to have forgotten over the last 2 years is that senior housing at the cusp of exponential growth. Over the next 25 years, the number of people over the age of 85 is going to grow by 300% in Canada, which is just truly remarkable. So that is going to have a significant demand for senior living product. On the reverse side, on the supply side, what we're having is we had quite a few construction projects. They stopped during COVID, or people didn't start new COVID projects during COVID. And then there was people were gearing up for building a lot more projects, as soon as COVID is declining. But given, and I'm not really sure if I will call it cost inflation versus it's a supply chain induced cost inflation. When you have one set of windows for every 3 companies who want to buy it, you can charge whatever you want because you only have one set of windows. So, the construction, we continue to hear from people how they're not canceling projects, but they're significantly delaying their project. And as we would all know, being in the real estate panel here, that this is not a product that you build in 6 months. It's going to take 3 to 5 years. So these supply chain issues obviously is going to have an impact on supply going forward. But for current owners, we have 80 properties in 3 provinces. It's a great place to be at because we know it's going to actually drive demand further. The second thing we always talked about in senior living is how baby boomers are eventually going to be our residents, because right now we take care of baby boomers' parents, not baby boomers. That is now changing. This year, I think the oldest baby boomer is 74 or 75. And we do start to see some of them coming into retirement homes. So the average age for our portfolio is around 85, but we do see people coming in around 74, 75, and we have started to see that. So when we were in the middle of crisis, I came in this role of June of 2020. Shortly afterwards, when we were able to put our head up, we were worried that one day we will wake up when the crisis is over and we would be a company focused on crisis, and we did not want to do that. And that launched us to really work on our retirement platform. That's where we launched Aspira, which is focused on personalization, choice, and vital to the local community. So we are hugely optimistic about our future. We had an incredible balance sheet going into the crisis, which we preserved for the most of the time, and in fact transacted on a big acquisition recently. We have a big balance sheet going into this next crisis, whatever it looks like over the next 6 to 12 months with interest rates uncertainty. It's an interesting time where you're in an inflationary environment on a cusp of recession, that some people would say, because you're not seeing everyone's profit margin going up, even though many things are more expensive. And I think your last question was around the mix of our portfolio. And we see many of our peers moving towards one of those, whether it's private pay or publicly funded long-term care. We feel it's an incredible strength to have both, because even over a short period of time, last 10 years where I've been with Sienna, I've seen different cycles have an impact. And over the last 25 years, just talking about long-term care stability, and over the last 2 years, we have talked a lot about the risks in long-term care. But over the last 25, 30 years in Ontario, where we had every political party in power during those time, the funding of long-term care always stayed up with inflation over time. There might be a bit of a lag, but it always stayed with inflation. We have a $2.5 billion asset value, and we have one of the best credit rating for a company our size, which is BBB mid. And we know clearly, because DBR has told it to us, it is because of your long-term care business. So it provides tremendous stability. And if we do get into a place where things don't look very good from an environment perspective, we can always count on a very stable cash flow from this business. Before COVID, our payout ratio was 65%. And in fact, it was long-term care retained cash flow, which helped us invest into retirement homes, where more than 50% of our business is retirement homes, where we do see huge pent-up demand. Our occupancy has gone up a record-breaking 830 basis points over the last 12 months, since May of 2021. So internally, we are firing on all cylinders and delivering on what we know is the experience that our residents are looking for.
So Nitin, thank you. That's great color. So if I hear you well, it looks like the demographic argument is still very well present, and still does make sense. Coming back to my question, in a post-pandemic world, how should we view operating margins for your business?
Sure. The two things which is going to, or maybe three things which will have an impact. The first is obviously your top line. So, when I talked about government funding over time would catch up with inflation, we feel confident that would happen, because there's every owners who's in it. Some of them are smaller, who would not have the depth of balance sheet as some of the bigger companies, and that annual cash flow is important. So we know that would come, and there might be a delay, but that would come. On rental rates, we're already seeing some of our US peers, reflecting the inflation and rental rates, and we would look at to do something similar, obviously in an organized fashion. So that's from a revenue perspective. From a cost perspective, there are really two things. The first one is labor, and the second one is utility cost. Mm-hmm. I'm not going to talk much about utility costs, because I'm not in the energy sector. So I think whatever we could hedge, we hedged at a time, and we are at the stage that we are at this current time. Labor is going to be the biggest challenge going forward, which is not a surprise for anyone. And we know there are a lot of programs federally and provincially to increase the number of healthcare workers in Canada. I would tell you, I don't feel optimistic that in the short to medium term, that's going to have a significant impact. In the long term, it would, but these things take a bit of time. Mm-hmm. And that's why, one of our strategic pillars is driving that alignment with team members. We know that the pool of healthcare workers is not going to change. However, companies which have a deeper alignment with the team members are going to have a better chance of retaining them, reducing some of the agency costs. So, and I don't think there's one item which will fix all of it. We recently announced the Sienna ownership program, where every employee in the company is going to be a shareholder. And think about the alignment that is going to drive with the team members. I do town hall sometimes in the middle of the night, because we have a night shift. And when the midnight PSW starts talking about your share price and what they can do to make a difference, now you're having a workforce which is deeply aligned to your work. Mm-hmm. So we are on that journey. We are in no way towards the end of it. We are at the beginning of it, and driving that alignment with the team members more and more, we know is going to have a significant impact on reducing that and managing that cost.
Mm-hmm. No, that's great. Thank you, Nitin. And continuing on that subject of demographic trends, Stavro, that's exactly what you're trying to exploit with your portfolio, being a newly listed company. But at the same time, at the outset of the pandemic, you're exposed to rent control. So how would you characterize, how the portfolio performed during the pandemic and where you are today?
Yeah, no, thanks. I mean, we're a pretty new company. Thanks, Fred. We're focused on 55 plus active living demographics. So kind of the stage in life before folks enter the residences of the rest of the peers on this panel. Typically we refer to these people as downsizers, so it's an affluent group. And given where home prices have gone, it's actually acting as an incentive for more entrants into or more tenants into our portfolio. So your question on the rent controls, most markets in Canada do have rent control. I'm from Calgary. It's interesting that our business is not in Calgary because that's one of the few that doesn't. But we saw the government of Brunswick take a couple of actions because I think they had to. I heard somewhere else on a previous panel that there are small landlords, bad actors, and we saw that in our market too. We saw people taking ownership of a building, small buildings, 10, 12 units. Day one rents are 800. Day two they move them to markets, $1,200, $1,400. You're basically putting people on the street. Those would hit the news headlines, and none of the large landlords would have done that. So I think the government had to take action as a result of that, and I think their action, the 3.8% rent control is still allows for a lot of CPI based. If we look at what's going on in 2022, that would be three times that, right? With the CPI rents, but it's CPI based. I think it still allows for a very healthy top line growth. We're seeing double digit lifts on rent as we turn units. So as a unit will become vacant and we release it, it goes closer to market, and that we're seeing double digit lifts. So if you assume 10% of your portfolio, which would be conservative, gets a 10% lift, again conservative, gives you another 1%. So that's 4.85% top line. That's pretty healthy top line growth. And then that I think that allows us to absorb any higher as our well laddered kind of debt mortgages come due. It allows us to absorb any rent increases, any cost increases, and it still gets some margin expansion. So
No,
I guess the other thing I didn't mention is that the government is in New Brunswick, which is our largest market. They're pretty attuned to the fact that they have one of the highest population growth rates in the country, and so they're pretty attuned to incentivizing new housing. One of the things they did is they reduced the tax levy on multifamily owners. So they committed over the next 3 years to step it down by 50%. Right, so our property taxes are going down over the next 3 years, and that's our biggest cost line item. Right, so I think there is a quid pro quo. And we did find out during this process that they listen, that they understand kind of, that and they're there to make this kind of a, win for the landlords, win for the tenants, and win for the government.
Do you think that this aspect that you just described is well understood by the market at this stage?
I think there's a lot. I think we
there's
operate
a lot going on. Yeah, absolutely.
Yeah, we operate in secondary markets, and there's not a lot of data on those markets. It's up to us to get those data points out. And but again, these, Fred, a lot of these portfolios that are in the public markets are in core markets, and secondary markets have been a huge beneficiary of population as people look for larger spaces, right? And work from home is. People are going to be working more from home in the future than they have historically, right? And that allows them to live further away from the office, and that's driving a lot of these trends.
No, that's great. And then moving on to Scott, entering in a pandemic, Scott, it looks like, you correct me if I'm wrong, your portfolio was a little bit exposed to Illinois, which kind of created all kinds of some problems, and then the pandemic hit you guys quite hard. Where are we now? What's the status of Invesque today? And how would you characterize the business plan from here?
Hi, Fred. Thanks for the invitation, and thanks for the question. So yeah, there's no doubt our portfolio was significantly hit during COVID. Remember, we have a portfolio that's mixed. So most of our portfolio, for your listeners or your viewers, is in the United States. We have very limited exposure in Canada. We're substantially all US. We got a portfolio of private pay seniors housing, what we call skilled nursing, which is sort of the equivalent of your long-term care, and then medical office buildings. All elements were hit in a negative way throughout COVID. Most substantially was our skilled nursing portfolio, the portfolio you referred to, Fred, an Illinois-based portfolio. of the equivalent of your long-term care beds. We probably had 800 or 900 of our residents that perished during COVID, and it was a there's no doubt there's meaningful implications there in a lot of ways. We've now built back some, but not all of that census. As Nitin talked before, it really was an amazing experience to work with the frontline employees that were there day in and day out, and I certainly have to thank them and tip my hat to them. And now to see them want to come back and rebuild the business and the portfolio, we're trending in the right direction. There's no doubt about it. Census continues to trend in the positive. It's taking time. There's no doubt about it. This is not a quick rebuild. Shortly after vaccines were announced, I got calls from people wanting to know if that was the turning point, and in the next couple of months, could we see a return to pre-COVID census? And the answer is no, absolutely not. It's going to take time from a few respects. First of all, you did have a sizable amount of deaths in that population. There's no doubt about it across the board. Not only those that are in facilities, but those that might have been heading to facilities are gone, unfortunately. Then you have to deal with the psychological implications of, that, call it 40 to 50-year-old daughter that's making a decision to put mom or dad in a facility. And during COVID, they couldn't get in to see mom or dad. They couldn't bring the grandkids in, and they need to make a decision. Do I want to take that chance again? Not only that, but do I want to take the chance some of these facilities turned into death traps? I mean, we all saw the headlines of, 40% of the people in the buildings died, at least in the US. We saw some of those. Thank God none in our portfolio. We didn't have any major sort of one or two buildings that had a disproportionately high level of deaths, but across the portfolio, there's no doubt we had deaths. So we did struggle. We are heading in the right direction. I'd say census is positive. I'd say NOI growth is returning. We have, on the seniors housing side, the private pay side, seen fairly sizable price increases that are at least with you asked me 2 weeks ago, I would have said ahead of inflation, but I think depending on which day you asked the question, I'm not sure I could say ahead of inflation anymore, but at least commensurate with inflation. We're still battling cost increases again. I don't want to repeat everything Nitin said because I'd rather people add new things, but we are struggling on the labor side, which is compressing margins. In terms of now your last question, the business plan, where are we, where we're heading? We've publicly announced that we had a highly diversified portfolio, MOB, skilled, seniors housing, and we are trying to simplify our portfolio, simplify our story, and simplify our balance sheet. It's I hate to say it's that simple, but that's really where we're heading. We've already announced about $290 million in dispositions over the last 12 months. And we have publicly announced that there are more coming. We're not in fire sale mode. We're not in a rush to unload. We're only going to sell when if appropriate, but we are repositioning to be predominantly private pay seniors housing.
That's very interesting. Thank you, Scott. And then moving on to Shailen, entering in the pandemic with multi-jurisdiction and multi-currency portfolio. It looks like there was some misunderstanding across the board, but you guys were able to grow. So so maybe you can give us kind of a sense of where you are now post-pandemic.
Yeah, thanks, Fred. Sorry, excuse me. And thanks for having us, and great panel. Maybe I just level set because our business is a little bit different. So Northwest Healthcare Properties REIT, we're about a $10 billion global healthcare real estate asset management business focused on the cure segment of healthcare. So that's perhaps where we're a little bit different. The other panelists and issuers have all talked about some of the seniors housing and SNF exposure that they have in some residential. Our business operates on the more acute side of healthcare, where we own medical office buildings, acute care hospitals, and ambulatory care. A lot of the dynamics around the demand trends are the same, but we don't necessarily have the same operating exposure, and our business is largely triple/quadruple net, and we act as really a real estate capital partner to the healthcare industry in terms of delivery of primary healthcare. In terms of the pandemic and how that impacted the business, I mean, listen, I'd really say it was the power of diversification. So you called out, multi-currency, multi-region, multi-asset class around the cure segment of healthcare. A lot was going on at the time of the pandemic, and I think investors in the general market, had difficulty digesting how businesses would be impacted. I think the power of diversification really resulted in us being able to balance out various waves in the pandemic, where we had different geographies impacted to different degrees at different times, and we almost had a little bit of synergy in terms of how we were able to manage our real estate and operator capital relationships. I'd say at the front end of the pandemic, there was a lot of concern around exposure to private healthcare, especially given that in most of our markets, private healthcare and private hospitals tend to serve, I'd say, the more elective surgery components of the acute healthcare space. And given that a lot of those services had been temporarily paused, there was a lot of concern on the viability of our operators and ultimately their ability to pay rent. I think what ended up happening, and quite frankly, it was a thesis that we wrote, and why we operate in the segments that we do, is really the market. I mean, the markets that we operate in, where there is private healthcare, that private healthcare capacity in an acute healthcare context acts as a little bit of a capacity relief valve for publicly funded healthcare systems. So the most direct and obvious one I look at is in the UK, which is actually a market we entered into during the depths of COVID and have now scaled to roughly $1 billion platform or so. But if you think about the UK, very similar to Canada's healthcare system in the context of universal healthcare, where you have a national health service, and then perhaps where it's a bit different to Canada is that it does have a private pay system. And then really what happened at the depth of the pandemic is you shut down the private pay system and all elective surgeries, and the NHS, the public healthcare system, contracted all of that capacity, and really acted as a backstop. So that ultimately gave us a lot of confidence and gave the market ultimately a lot of confidence in terms of our operators' ability to pay rent. And we saw that trend play out in markets like Australia. We saw it play out in markets like Germany, where we operate. So I'd say it was the market. I mean, it's the power of diversification at the front end, and then ultimately, I think, it was having a thesis around healthcare and acute healthcare operations that balances both public and private healthcare exposure. So during the pandemic, we grew our business almost 25%. We entered 2 new markets. So we entered the UK quite opportunistically with a distressed vendor with primary exposure to U.S. seniors housing that was looking to rebalance its portfolio and recapitalize. So it sold off a portfolio of UK-based private hospitals. We'd been looking at that market for a long time. So we felt that was a prudent time to enter the market. We also would caveat that we'd spent 2 or 3 years prior to the pandemic significantly improving the balance sheet. So we came into the pandemic with a pretty strong balance sheet that gave us the ability to operate or to execute an opportunity. And then, separate to the UK, I'd call out that the REIT just completed its first acquisition in the US. It's been a market that we've looked at for almost 10 years, and then coming out of the pandemic, or at least the depths of it, and into this endemic world, felt there was a bit of dislocation around cure-focused healthcare real estate in the medical office building segments, as well as in some of the ambulatory care and outpatient segments. So we did recently enter into the U.S. market about a quarter ago with a $750 million portfolio acquisition. So again, I think it was staying true to our values, staying true to I'd say diversification in our business, and having a very strong balance sheet that allowed us to grow over the last 18, 24 months.
Oh, that's great, Shailen. Thank you for that. And then at the outset of the pandemic, we're in a world where inflation seems to be keeps picking up a little bit, and your portfolio is 75% contractual agreements linked to inflation. Do you so first of all, I mean, how do you feel about that? And second, how much of a drag, I guess the 25% is the Canadian portfolio, how much of a drag the Canadian portfolio could become in that environment, in your opinion?
Yeah. So again, a bit of level setting. So roughly a $10 billion global portfolio. About 2/3 of that is leased to what I'm going to call, acute hospital operators or ambulatory care operators, where we have triple to quadruple net leases, where effectively we're just acting as real estate capital and in some cases some incremental development capital, where we have rents that are fully indexed to inflation. Each lease has its, a slightly different structure. Perhaps there's some caps and collars, again, when we would have structured those, and a lot of them would have been in place for some time, it was hard to envision a world where you might have seen a, 5-7% print on inflation. If we looked at our global markets and our exposure, our weighted average CPI index, if you may, hovers in around 5.5 to 6%. It would have been hard to envision that, 5 to 7 years ago. The remaining third of the portfolio roughly is medical office buildings, primarily in Canada, where some landlord 25 years ago gave up an indexation clause, and it's been impossible to recreate since. So a lot of our almost all of our Canadian leases are gross / semi-gross, and tend to be shorter term in nature, call it 5 to 7 years, and they reset on renewal. Although I'd caveat that the Canadian healthcare system, just as it's structured, provides limited opportunities for rental uplift, given that top lines for our tenancies, call it GPs, primary care, aren't necessarily growing. So then coming to the crux of that, what that all means, at about a 5 to 5.5, 6% inflation level, the REIT has about 70% capture against our CPI indexed. Part of that is just the natural rollover curve on our Canadian portfolio, which tends to have that 5 to 7 year term, weighted average lease term. And then part of it is that we do have some caps, in place on our international portfolio. So again, at 70% out of the gate, being indexed, we feel pretty comfortable. Then I guess it comes to your question around Canada. We think there's a lot of benefits to being in the Canadian market today, and that's why we're there. I remember, I've been with the business since we took the Canadian business public, and as part of incubating the international strategy. And at points in time, I felt like the international strategy acted as the growth vehicle, and Canadian was the stay-at-home defenseman, if you may. And at moments in time, I felt like the opposite. So I think again, it's around that diversification story that we feel like with Canada, we balance out some of the more acute care private pay exposure we have, with ultimately, in some ways to think about it as a play on a provincial bond, given the healthcare funding model. So yes, it does act as a little bit of a drag against our overall indexation levels, but if we are to see real inflation start to hit the bottom line, through businesses in Canada, and start to see a robust economy, although I would caveat that that's probably not where we see things over the next 12 to 18 months, that does actually provide some support for rent growth in medical office buildings over time. So again, we see some near-term pressure points in the Canadian portfolio, but I think in the balance of it representing 10 to 15% of our global portfolio, it's manageable.
Yeah, no, that's totally fair. And moving back to Nitin and the subject of access to capital, you guys have been quite creative and were able to find a great partner to grow here in Canada, but based in the US. How would you characterize first of all, the appetite from US investors to invest in Canada, and how did that opportunity came along to you guys?
Sure. So you're referencing our recent portfolio acquisition of 12 different homes, 5 in Saskatchewan and 7 in Ontario, with Stavro Healthcare REIT. We bought 11 from Extended Care and another one from an independent owner operator. So for a total acquisition price of around $400 million. So we have been in partners with Stavro for 5 years. We have been managing their portfolio of 8 homes in Canada. And we've been talking about looking at the right opportunity when the right opportunity presents itself. And this one seemed like the right opportunity. So, obviously not being able to not have to raise capital during a time when you're trading below NAV is helpful. And the management fee definitely helps from a return perspective. We also have a partnership with Reichman Senior Housing, where we are developing a home together, but that will have a short window because the eventual goal for Reichman would be to sell it once it's fully developed. I would say we are very picky with partners. We would rather have less homes, which we have more ownership interest, than more homes, with less ownership interest and more partners. These relationships not easy. They take 25. This is not something you can unravel after development. Everyone walks away. No, you are partners forever, or for a long period of time. So we feel very aligned with Sabra. Our culture is quite similar. How we work, it's quite similar. There's mutual respect for each other's expertise. So you'll continue to see us partnering where it would make sense, but that would not be the only primary way for us to grow, because we're also very comfortable just growing by ourselves, which we've done in the past.
Got it. No, that's great. And then Stavro, you have quite a solid institutional following. What's the status of that following today in the current market conditions?
We communicate with our investors, and obviously this is a very volatile environment. The alternative investment thesis comes to play. I mean, I think you can buy Bell bonds for 6%. These 30-year Bell bonds for that yield 6%. So I can see why people have to understand. But we've attracted institutional investors. We're a really small company. We've attracted institutional investors primarily because those investors saw the growth embedded in our portfolio. Mm-hmm. Everything I see in print is typically point in time metrics, cap rates, day one, snapshot. And, as I mentioned, we have a lot of embedded growth in our portfolio. I mentioned that before in terms of us seeing a 5% top line organically without considering the acquisition growth. And so that, I think, offers a lot of value. And I still remember, Fred, and you might remember this too, where, in the 90s, when we're looking at some of these from a different career, a different role when I was that, REITs were buying properties at negative funding rates. So you'd be buying an 8 cap when you were financing it with a 10 cap, with 10% mortgage. And the reason was you would be able to underwrite the growth in rents, and that was a good decision at the time, because rents did grow to offset that, and then cap rates compressed for value, so values expanded. But we still see a positive spread investment. We're able to generate double-digit IRRs day one, and then we typically have the ability to find more value in those portfolios that we buy. So I think it's still an interesting return profile. And the underlying drivers of those returns is what all the multifamily panelists said in previous sessions, is that there's a really high supply and demand tension in the market for these apartments, and home prices have reset higher in Canada, which makes the calculus of renting versus buying much more attractive, right? At all slices of cohorts in the population. And so we have a niche in that, but that drives a lot of what is going on, right? So when I talk to our investors, I think our implied cap rate on our current in place NOI of 5% plus 5% represents a pretty good deal.
Yeah, no, absolutely. And then moving on to Scott, you have quite limited access to capital, but I want to underline the massive work you did on the portfolio. What's your timeline, and how should we see the balance sheet evolving from here?
So it's hard for me I want to be careful about a specific timeline. I'd say my broad vision is over the next 12 months to reposition the portfolio to be substantially all, maybe not exclusively, but substantially all private pay seniors housing. So then if you work backwards from there, by definition, that means there will be dispositions of non-seniors housing assets, which will generate cash flows in excess of the debt that we will use to both delever, and not only delever, but as you know, Fred, we're fairly aggressive in our growth. We grew very fast, 2016 to 19. We were the fastest growing public real estate company in North America. And in order to do that, we structure deals in lots of creative ways. So as a result, we now have a series of prefs on our balance sheet and converts on our balance sheet and a number of other esoteric securities that at this point in time, where we focus on the simple word simplification that I talked about before, I do want to eliminate a lot of those. So I've publicly disclosed, and I'll repeat, that you should expect to see us divesting of non-core assets that are inconsistent with where we're taking the strategy, and use of excess cash proceeds to both delever and more broadly to buy in some of our prefs. We have the ability to buy in all of our prefs, we have the ability to buy in our converts. So you should expect to see us doing some of that. And my broad range of timeline to get specific is probably 12-ish months plus or minus to get us in that position that I hope to be in.
Mm-hmm. No, that's totally fair. And how would you characterize the demand out there today at this stage in the cycle for your non-core assets?
So I think it really depends on, it is very market specific, especially on the skilled side. You know, a lot of skilled assets, they are operated by local operators, regional operators, family businesses. Some of those operators want to become owner operators. They are owner operators of other skilled assets. So it really does depend. There are some markets that are more robust than others, and we're trying to be selective. That's why I've been very particular in my language selection and careful to not say we are exiting the skilled business, because I can't. I'm not going to just say, all right, we're out, so anyone that wants to pay anything, come let me know. I assure you a number of those buyers have reached out, but that's just not reality. We're going to wait for the right pricing, and we're in no hurry. When I say 12 months could actually be 36 months. There isn't a gun to our head. There isn't a specific timeline. But I think based on what I see in the pipeline now, where I think there is appropriate demand and pricing, I think in 12 months we'll be substantially out, maybe not entirely out. And again, to be very clear, Fred, it really does depend on local markets. You know, I can give you an example in that we recently sold 2 assets in upstate New York to a family owner operator based in New Jersey. So, you know, other parts of the country never looked at it, wouldn't have been interested in it. It wasn't really a broad regional play. It was specific to this northern or upstate New York market. And there's a particular operator that made sense for. We believe that operator paid us well for it, and we've disclosed the pricing on that. So you can all make your own judgment. But that was unique to that operator and that owner. And I think in a broad market, sort of everyone submit bids, you wouldn't have seen similar pricing because others wouldn't have valued it the same way.
Mm-hmm. Mm-hmm. That's great. Thank you. And then Shailen, in terms of access to capital, you took a different approach, and it looks like your asset management platform is growing quite fast with you know, different partners. How would you qualify the demand out there to partner with you guys, and what are your views on the platform going forward?
Yeah, thanks for that, Fred. So maybe just level setting. When I introduced ourselves, I said global healthcare real estate asset manager. A lot of words there, but asset manager, I think, is a big shift in our business. We used to call ourselves a REIT. We still are structured as a REIT, but increasingly we're seeing our platform evolve to invest, you know, long-term sovereign wealth fund money, as well as other direct institutional capital. So at about $10.3 billion, our current gross book value or AUM, the REIT today has about 55 to 57% look through ownership into those assets. And you know, if we looked at our business 5 years from now, we probably see ourselves diluting that ownership to about 30%. And we'll really do that by way of selling our 100% owned portfolios into capital platforms, and then continuing to grow those capital vehicles, which have existing commitments in excess of $10 to $12 billion. I'd say we're in a couple processes today where we're taking fairly discrete portfolios. You know, I mentioned our UK portfolio, which was really a COVID strategy and an asset repositioning strategy, where we scaled from 0 to roughly $1 billion in assets, and we're now looking to bring in an equity partner into that portfolio, and that process is well underway. It started, I'd say, you know, at the tail end of, you know, or at least when we saw some stability in Europe around COVID last summer. And you know, so I mean, so it started well before this current moment of volatility. And then we have a second process in the US, where we recently bought out a portfolio about $750 million. We're looking to bring in a co-investor to embark on a more programmatic US strategy. What I can say about both of those processes is that they're taking longer than expected, although we see that some of the fundamentals, and you know, really, I think every one of our panelists can say that the demand drivers around our respective sectors are exceptionally positive. And I think if you look on a more macro basis, and look with a bit more of look with a bit more time horizon, that wall of capital is still there. It just might be a little bit more selective, and it might be repricing a little bit in the moment. Especially as you start to look for larger commitments. I came out of NAREIT last week in the US, and I would say if we're having this discussion in a traditional asset class, whether it be office or retail, the discussion would be very different. But I'd say for predominantly the healthcare sector, and I'll speak to that more precisely, we continue to see that wall of capital out there. And I think that's micro to the healthcare sector and macro to the thematic around private real estate valuations.
So how do you feel about, I guess, the implied value that the market's giving you for that asset management platform?
Yeah, it's a really good question. Right?
I know the answer. I know
my
answer,
is
but
undervalued. But there you go.
No, but I mean, how should investors view it?
Yeah, I think it's really interesting for our business at a micro level, and maybe that's what I'll speak to. We kind of stumbled upon becoming an asset manager, and it's now become the primary driver of our business, whether it be earnings growth or NAV growth. I think the market in our business specifically has had just a little bit of difficulty trying to assess what the long-term recurring revenue is out of some of these management contracts. And I'd call out that these management contracts that we have are very much perpetual in nature. They're structured more as JVs than finite life, funds. And I think because we've seen this part of our business grow quite rapidly over the last 12 to 18 months, there's just been so much momentum and a bit of noise in the numbers that people just haven't really been able to get up to speed with what's going on. But we do put a lot of guidance out there in the market on this specific issue. We think today our asset management platform embedded in our business is probably carried at about a 12 to 13x multiple. If you looked at alternative real estate asset managers, and I would call out we're in a moment of volatility. If you went pre this moment of volatility, you would look at the best in class trading north of 25 to 28 times. So more than double where we are. That's probably come down to low 20s today. In this moment. But, I think when you look at a platform like ours and the power of some of those contracts and the duration of some of those contracts around management fee streams, we believe that it's highly defensible and, probably grossly undervalued.
No, that's totally fair. We got 4 minutes left. I'm taking the liberty to ask Nitin a question. I want to hear a little bit more about the rationale of going a little bit outside your typical core markets of BC and Ontario with Sabra. How did that opportunity come along, and what's the rationale?
Sure. So we have been looking to grow outside of those two provinces. We have looked at Alberta or Saskatchewan, and we were open to either one, wherever the opportunity showed up first. It just happened to be in Saskatchewan. As Extendicare was exiting with 4 properties, and then there was another seller who saw an opportune time to also sell their home because they thought whoever is buying the 4 assets wants the 5th one, which made sense because the 4 would have been too small for us. Saskatchewan retirement space is relatively new, so they have significant upswing in number of new builds, but the rental rate increase has been very consistent on 3-4%. The capture rate is after Ontario, BC, and Quebec is the 4th highest, which is extremely strong. And the government is very focused on fixing healthcare. We think there is a huge opportunity to be able to partner with government outside of long-term care, where there's a whole pent-up surgery demand. So I think there are multiple opportunities there. It is a province which get overlooked sometimes, which is fine by us. We don't have to be flashy. We don't have to be on Yonge and Eglinton. We are fine being in Regina and Saskatchewan, where there's good business fundamentals. If it wasn't, one of the things which doesn't get talked about during COVID is how strong the Saskatchewan economy is rebounded, especially driven by agriculture and fertilizer and resources. So we think it's an incredible market to be part of, and we are actually looking forward to growing that market more for the right opportunities. And we will look at Alberta when those opportunities show up.
That's interesting. All right. Well, that concludes our panel today. I want to thank you very warmly for your time, and that was extremely interesting. And for everyone else, please stick around, and we're going to have our next panel at 3:15 on urban densification. So thanks again, the 4 of you.
Thank you. Thanks for having us
Thank you,
all.
Fred. Great to see everybody.
Thank you.